I'm Grant Walker. Welcome to Last Call for Thursday, the 2nd of July. I'll be back with Heads Up Friday, 10 a.m. Back to Briscoe's. The Briscoe Group's takeover bid for outdoor equipment retailer Kathmandu is below par, according to Forsyth Barr. Briscoe, which is 80% owned by Rod Duke, launched its full takeover of Kathmandu yesterday afternoon after telling the market on Tuesday that it had acquired a 19.9% shareholding, mainly through buying out institutional shareholders at $180 a share. The well-performing retailer, which operates the Briscoe's Homeware, Rebel Sport and Living and Giving stores, is offering $89.7 million of its own shares and $32.3 million cash for the 80.1% of Kathmandu it doesn't already own. The offer is 5 Briscoe shares for every 9 Kathmandu shares plus 20 cents a share, which at current prices, Briscoe's at $280, works out at $176 or 4 cents below what was offered to institutions. Forsyth Barr retail sector analyst Chelsea Ledbetter says in a research note released this morning, the proposed takeover offer is materially below Forsyth Bid's value range of $189 to $250, using Australasian retail sector merger and acquisition transaction multiples. She says while the 2015 financial year valuations for the proposed takeover offer appear attractive, this reflects suppressed earnings and is not reflective of the earnings potential of Kathmandu. She said, we see this as an opportunistic move by Briscoe given the suppressed nature of Kathmandu's share price following weak earnings results. We see limited synergy opportunities between the two companies. We do not expect the proposed bid to be successful on the currently disclosed terms and do not expect Kathmandu's board to support a takeover offer at these levels. Forsyth Barr expects Briscoe will have to raise its proposed bid and possibly offer more cash to be successful. Its share price slumped in January after a profit warning a weak outlook for the year ahead, and at the time there was speculation over who would launch a takeover bid. However, Forsyth Barr believes it can recover from the weak trading period due to its strong brand, market-leading position and vertically integrated model. On the other hand, a Morningstar analyst thinks Kathmandu could benefit from new management. The analyst says management could turn around Kathmandu's flailing operations by closing down underperforming stores, reinvigorating existing stores and investing in the brand. Kathmandu will benefit from adopting Briscoe's best practices, he says, albeit before the offer price was announced. Under Mr. Duke's leadership, the retailer's shares have climbed 130% in the past 5 years as he drove sales growth at his homeware and sports goods stores. He told NBR News editor Duncan Bridgman he was confident he would conquer Kathmandu and waved away suggestions of a hostile takeover. Kathmandu has engaged investment bank Goldman Sachs as its defence advisor. Goldman Sachs Asset Management is the retailer's largest shareholder with a 12.3% stake. To copper pricing. Chorus has scored a key win in the ongoing war over the regulated wholesale price of copper lines. The Commerce Commission has set a regulated price of $38.43 per month. That's a reduction on the former price of $44.98, but also not nearly as bad a cut as Chorus had initially feared. In November 2013, the Comcom set a price of $34.44, which is what retailers like Spark, Vodafone and Call Plus have been paying Chorus since December 1st, 2014. It was the slice to $34.44 that set off panic at Chorus and its major shareholder, the Crown, and the company's warning over $1 billion hole in its earnings up to 2019 that saw its share price head south, its debt rise, and its once-fat dividends put on hold. ISPs complained $34.44 was still more expensive than comparable overseas companies, and a review process was triggered. In December, the Comcom released its initial pricing principles, or IPP decision, which actually raised the price to $38.39 following a review that was based on the cost of building a modern equivalent replacement network. This morning, following its final pricing principles review, the regulator has released its final draft price. Analysts approached by NBR yesterday were picking it would be close to the IPP price, and indeed that's where it's landed. Telecommunications Commissioner Stephen Gale says the regulator has come to an initial decision not to backdate pricing. However, Dr. Gale says there will be consultation on this point. Given the final draft price is higher than the $34.44 retailers have been paying since December, Chorus misses out on a backdating windfall. That's a bit of a setback, but the company will be much more focused on its headline win. So what does it mean for investors and customers? Well, for Chorus investors, it means the earnings damage is much less than initially feared. Analysts expect that if the regulator stuck closely to its IPP pricing, as it has, then dividends would resume in the next year, although at what levels is a more open question. And for consumers, well, it shouldn't mean any change to broadband pricing. When the initial $10 cut was announced, ISPs immediately cut their pricing, and indeed Spark included the figure in its earnings guidance. But when the December decision indicated the Comcom was leaning toward a cut of $6.50 or so, internet providers quietly put their prices up by around $5 per month in the new year. To Greece, Eurozone finance ministers have put further bailout talks with Greece on hold until after Sunday's referendum. A meeting between finance ministers representing the 19 Eurozone countries last night, early this morning New Zealand time, ended with the agreement to conduct no further talks until the people of Greece have had their say. Yesterday, Greece defaulted on its $1.6 billion IMF loan, becoming the first developed country in history to do so. Eurozone President Jeroen Dijsselbloem says given the political situation, the rejection of the previous proposals and the recommendation by the Greek government to vote no on the referendum, there is no grounds for further talks. He says there will be no talks in the coming days, either at Eurogroup level or between the Greek authorities and the institutions on proposals or financial arrangements. Before the meeting of the finance ministers, German Chancellor Angela Merkel was vocal that no further negotiations should be held until after Sunday's referendum. Greek Prime Minister Alexis Tsipras and his government have been outspoken in urging the Greek people to vote no on Sunday. In a television address, Mr. Tsipras said Sunday's referendum is not about whether the country will remain in the Eurozone or not. That's a given and no one can doubt that. On Sunday, we choose whether we will accept the specific agreement or seek a more viable solution with the public's approval. He reiterated the government's unwavering intention to reach a deal with the creditors, but with terms that are viable and have potential. Meanwhile, there is still unrest in Greece and the population is split on whether it should vote yes or no this Sunday. Yesterday, thousands gathered on the streets of Athens voicing their opinions. There were two different rallies, one supporting the government's rejection of the proposed austerity measures and the other calling for them to be adopted so Greece can remain in the Eurozone. Banks remain closed until July 6 and a €60 per person limit is still in place on ATMs across the country.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
NBR Radio, Thursday the 2nd of July. I'm Andrew Patterson. This is Media Matters, and with me, Campbell Gibson and Nick Grant. Campbell, let's start with the arrival of Apple Music. What sort of an impact do you think this is going to have on the scene, the media scene?
Well, they themselves are promising it to be revolutionary, and I wouldn't actually expect it to be far from the truth, to be honest, because Apple's got such a monopoly on that music industry that it'll be easy for them, to sort of convert their brand and use it for the service. So its main competitor in this space is Spotify, and Spotify's been around for quite a long time, and they've both got sort of very similar stats. They've both got about 30 million songs. They're both priced at about $13 a month if you choose to pay for Spotify. So the main differentiator here, from what I've seen from commentators, is that Apple's going to rely on its incredibly well-recognised brand, as well as its marketing prowess, and it's a very well-established 800 million user base. And looking at that, you actually only have to see that it'd have to convert about 2.5% of those 800 million users before it's beating Spotify in terms of paid users. So it's... Yeah, it's going to change a lot of things in that industry, I think.
And the issue, I guess, for it will be, will it make money for Apple here, do you think?
I believe so. They've got a lot of things that will sort of place it on top of the other music subscription services out there. Spotify is, it's quite radio-based, but Apple Music actually has its own radio now, and it's also starting up its own social networking service on Apple Music and Connect, so that allows music artists to share photos, videos, songs as well directly to their listener base. So they've got a very strong proposition, I think, and music revenues in terms of selling songs and albums on their own have been sort of declining for a little while now for Apple. So this is a way for them to sort of reinvigorate that industry and especially pitch it as something that's quite cost effective, because $13 a month, that's the equivalent of an album. So,
and clearly it's going to potentially have some impact on the music radio stations as well.
Yeah, well, with that radio station, Beats One is what it's called. I think I've seen a few comments around the marketplace that something like that is going to have sort of an impact on the incumbent music radio industry.
Nick, let's talk about TV ratings out this week. I understand TVNZ announcing that it might be looking to return Our First Home.
Yeah, Our First Home, a reality series in which, what could be more Kiwi than this, families helping their children onto the property ladder. It was, not surprisingly, I guess, in hindsight, a ratings hit for TV1 with an average of 375,000 viewers throughout the series. And the final live auction week attracted more than 500,000 viewers each episode. So, based on those figures, they would have been crazy not to renew it. I mean, it's maybe interesting to compare and contrast those ratings with the reality shows that MediaWorks is kind of banking its future on. And, I have expressed a bit of puzzlement about the strategy in the past and suggested that, the reality formats like the ones that they have imported and made local versions of kind of losing their grip on audiences' imaginations worldwide. That doesn't necessarily reflected in the ratings, though. I mean, it's absolutely dependent on the particular property. X Factor earlier this year was something of a disappointment. I think the final of this season drew just around about 320,000, as opposed to 560,000 viewers of 2013 final. I'd be surprised if we saw X Factor New Zealand coming back to MediaWorks next year, given the kind of costs involved in staging it. However, The Bachelor in New Zealand was a big hit, but that was a show that obviously caught people's imagination, and obviously the various apparently embarrassing stories about various contestants, etc. in the media, I think only helped the show along.
The issue with all of these formats is that they have a good run when they start. Because they're fresh to the market, and then of course the decay factor begins to set in, doesn't it? Yeah,
that's right. Well, that's what you tend to think, though. Dancing with the Stars, which was resurrected from from some years ago, seems to be rating its socks off. So they've obviously done well there too. I think a couple of weeks ago they were getting over 400,000. However, the other reality show that TV3 has launched recently, Come Dine With Me, New Zealand, which was a kind of like a quickie that they've shoved into the 7 p.m. slot after
the demise of Campbell Live.
After the demise of Campbell Live, and after repeats of Road Cops surprisingly didn't rate particularly well. Unfortunately, Come Dine With Me New Zealand, for the company, isn't performing at all well, and is languishing around about the
it's a terrible program.
Mark. Yeah, well, it's a shame though, because I don't know. I've only seen bits and pieces of the New Zealand version, but I've watched an episode or two. I had to, for reviewing purposes, a couple of years ago of the British version, and as a cheap and cheerful reality show, it does have some merit, and I think it was well within the scope of the people making the New Zealand version to do a much better job.
Yeah,
it was supposed to be it was supposed to be screening next year, so they
rushed it.
And they were still, I believe they're still advertising for people to appear on it, which isn't.
Yeah, I mean,
great.
The talent selection is so important on shows like that,
yeah,
particularly when you're in a dining situation to make it work. Now, the other issue with MediaWorks is the departure of some more high-profile individuals.
Yeah, well, I did an online article a couple of weeks ago about the announcement that Herald Gossip columnist Rachel Glusina was leaving NZME to take up a joint venture opportunity with MediaWorks. We canvassed that quite well at the time. But at the same time, I heard that there were a couple of people being let go from the TV3 newsroom. However, inquiries to MediaWorks, they insisted that actually there were just a couple of positions under review, but have since heard from other sources that definitely John Hale, who's a 25-year veteran of the MediaWorks newsroom and was the lead producer for the 3 News bulletin at 6 p.m, was let go a couple of weeks ago, which is an interesting move. I mean, there's a huge amount of institutional knowledge and talent being lost his departure. And it does suggest to me that that MediaWorks is seriously looking at downsizing their 6 o'clock bulletin to half an hour to bring it in line with what they've done on Sunday.
Mm. Yeah, and clearly the Sunday approach is a pilot, presumably, for what's going to be happening in midweek as well.
Yeah, you'd think so. Yeah, and and then presumably you'd look at having Story, which is which was announced last week as being the new current affairs show for the 7 p.m. slot. That would presumably be moved back to 6:30, and they'll have a straight-up entertainment show on at 7.
So Newsworthy, despite your prediction, Nick, is probably unlikely to change where it is at the moment.
That's right. I have to put my hand up and admit that I got it totally wrong. I thought Newsworthy, which is the
10:30
the newish 10:30 news bulletin with along with quirky stories, was actually just going to be trialled at 10:30, then shifted to the 7 p.m. slot. I do think, if they'd had more time, I think that may have been what they had planned, but because I think, they had hoped to keep Campbell Live going, I think, until the end of the year. Mm. And, I mean, that certainly would have given Newsworthy sufficient time to road test the team and product and make it shipshape for 7.
But the decision to go with Duncan Garner and Heather Duplessis-Allen does perhaps reinforce the fact that they do want a harder edge news angle on that slot.
Yeah, well, the bounce back in ratings for Campbell Live when it was announced that it was under threat showed that there is an appetite for it, and the review into the future of Campbell Live did acknowledge that, but they were very clear about it not being fluffy or soft, but something a bit more entertaining, certainly in the latter half of the program.
How do you think it's going to rate, Campbell?
Yeah, to be that, like Nick said, that kickback on the Campbell Live shows showed that there was still quite an appetite for a serious kind of current affairs show in the 7 p.m. slot. And obviously, they've indicated that it's going to be a bit more sort of entertaining than Campbell Live, but I would personally expect the ratings to be similar to how Campbell Live tracked, sort of pretty average and okay for the short term, and then over time I think it will slowly decline.
Which then raises this question of why would you get rid of Campbell to put another show on that is just effectively holding the same rating?
That is the golden question.
Well, and the big problem that that Story's going to have, that Campbell Live had, is that 3 News is not delivering an audience of any great numbers to the program. In fact, Campbell Live was often picking up extra viewers that
would come in despite the news.
Yeah, exactly. And a swallow does not a summer make, but there have been a couple of times over the last few weeks in which the TV3 6 o'clock bulletin has been outrated by the 5:30 news on Prime, which ironically enough is also produced by MediaWorks,
which might be why they're thinking that the half-hour slot is going to be a better format to run with.
Yeah, well, and it's got the advantage of let's face it. I mean, the 1 hour news bulletin these days on whatever channel that you look at is full of padding, and the intros and outros are incredibly repetitive. Coming up, teasing the content, etc. I mean, the actual news that you have in there. The news that's kind of legitimate and of some import could easily be boiled down to half an hour.
All right.
And save costs as well.
Thank you both for joining us, Nick Grant and Campbell Gibson, on Media Matters here on NBR Radio.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
To dairy prices. Dairy product prices continued their slide, paced by whole milk powder in the latest GDT auction, weakening to the lowest level in 6 years. The GDT average winning prices dropped 5.9% from US 2276 from 2409 at the previous auction 2 weeks ago. It was the lowest level since July 2009. Some 33,200 tonnes of product was sold, the highest volume since the January 6 auction, and up from 24,047 tonnes of product 2 weeks ago. The Agri HQ 2015-16 Farmgate milk price decreased 45 cents to $5.05 per kilogram milk solids following the auction. That compares with Fonterra's 2015-16 milk price forecast of $5.25. Agri-HQ dairy analyst Susan Kilsby said in a note the NZX futures market anticipated whole milk powder prices would fall overnight. However, the market underestimated the size of the fall. Whole milk powder sank 10.8%, buttermilk powder shed 8.1%, and skim milk powder declined 5.8%. Ms Kilby said the last time milk powder prices were this low was 6 years ago. At that time, demand was limited due to the global financial crisis. And the outlook is not favourable. She said it will be difficult for dairy commodity prices to increase significantly in the coming months as the quantity of milk powder available on GDT will rise with New Zealand's seasonal increase in production. Cheddar dropped 4.9%, while rennet casein fell 4.1%, butter slipped 0.3%. In contrast, anhydrous milk fat rose 1.6%. Sweet whey powder was not offered at the latest event. For lactose, no average price could be calculated because the product was either not offered, not sold, or sold at the starting price. The New Zealand dollar last traded at 67.52 US at about 155 in New York, compared with 68 US cents at 5 yesterday in Wellington. There were 140 winning bidders out of 158 participating bidders at the 11-round auction. The number of qualified bidders rose to 652 from 649 at the last auction. To a market update, Chorus shares fell after the Commerce Commission's latest ruling on wholesale telecommunications prices was largely unchanged, though the regulator changed tack on whether any update will be backdated. The regulator today released its draft determination for what Chorus can charge on its regulated copper lines in its final pricing principle, a more rigorous process to find the price than the initial pricing principle, which relied on international benchmarks. The Commission proposes setting the total price Chorus can charge for the wholesale broadband services at an average $38.43 per month, largely in line with the $38.39 price established in an earlier estimate, and up from the $34.44 price set in the benchmarking process, which came into effect on December 1. Chorus shares fell 0.7% to $2.98, while Spark New Zealand, the company's biggest customer, gained 0.2% to $2.79. Telecommunications Commissioner Stephen Gale said in a statement, "The modelled price released today is very similar to the draft we released in December, and continues to reflect that New Zealand's local loop network is unique when compared to overseas benchmarks. We've done further analysis on this, and it's clear that our dispersed population is a significant cost factor. The regulator is seeking submissions on the latest draft due on August 13 and will deliver its final verdict in December."
NBR Radio on Thursday, the 2nd of July. I'm Andrew Patterson, and of course the declining fortunes for Fonterra. Another fall in the global dairy trade price overnight. With us, Con Williams, economist with ANZ Bank. Con, what did you make of the numbers? Because they were actually a little bit sharper than the futures were indicating yesterday.
I think they were very disappointing, really. Basically, the market's going to struggle to cope with the seasonal uptick in New Zealand supply, and that was reflected at overnight's auction. And basically, most buyers' immediate demand requirements must be pretty full with the price action that you saw, particularly for near-term delivery of whole milk powder. So that's going to weigh quite heavily on the next few auctions over the next few months, have a higher weighting for the season average milk price, and so that's going to weigh quite heavily on the outlook for the 15-16 milk price.
So the number was even worse than what you had been forecasting?
Look, picking results from auction to auction are quite difficult, just because there's not a lot of information on the buy side. That's going to improve hopefully in the next little while. But yeah, I wouldn't have thought we would have seen that big a decline.
How will this impact Fonterra in terms of their estimates, particularly obviously the payout forecast? What are the implications from here?
We've downgraded our milk price forecast to $4.50 for the 15-16 season. The currency's obviously moving in the right direction, but hedging policy will dictate that the full benefit won't flow through solely to the 15-16 season of a lower currency. And there isn't much on the horizon to suggest that there's going to be any meaningful turnaround in powder prices anytime soon. So it's going to weigh on Fonterra's opening milk price forecast of $5.25. There was quite a wide range if you look at the other dairy companies, some up towards the mid-5s, obviously Open Country Dairy in the high 4s, So our latest forecast is actually below all of those current forecasts for the main players in the industry.
What is this going to mean in terms of, I guess, the ongoing pricing? Is this just all a supply-led problem?
No, there's an array of things that are buffeting the dairy market at the moment, both on the supply and demand side. Ultimately, if you look at the cycle in dairy pricing, it's been governed by supply, and essentially supply growth from the major exporters has come back below what you call the trend growth rate over the last 8 years or so. But it's still at a high level from the growth that we saw through the 2014 period. So that means his actual milk output is still pretty high across the major exporters, which is really kind of impacting on prices. But that said, on the demand side, we haven't really seen the full correction of lower wholesale pricing into retail pricing across a number of key export destinations, such as China. And I think that's been quite lagged this time, and that's kind of been notable. And that basically slows down the demand response you see, particularly from those price-sensitive importing dairy markets, where they're more price-sensitive to the price of fresh milk and other dairy products on the retail shelf. And I think that's kind of interesting, is that probably if you look at the intermediaries and dairy manufacturers, their financial results weren't great through the first, probably over the last 8-9 months. It wasn't just Fonterra that had kind of a shocker in terms of their earnings outlook and forecasts and how they kind of played out. So I think those intermediaries and dairy companies are trying to hold margins up through the supply chain to try and crib back some of those lost earnings for their shareholders. But we expect that competition to increase as we move forward, which should lead to lower retail prices and hopefully stimulate a bit more demand as well. So it's going to need to be a response like that, as well as probably lower farm gate prices, particularly offshore.
And of course, really at this point, Fonterra has to accept the pricing, obviously, that the market is determining, and there was a sense that maybe we were starting to bottom out, but the pricing overnight would suggest that maybe we still haven't found the bottom yet.
Yeah, it's hard to judge when you're kind of well below what you call cost of production or fair value about where the bottom might be. If you look at some markets such as skim milk powder, you've got intervention pricing in Europe, which we're very close to, or right on the edge for now, international pricing. So you kind of expect that to be somewhat of a bottom. But if you look at the height of the GFC, we did punch through that for a period of time. If that policy mechanism does start to, say, kick into place in Europe, there has been some trades from some commercial companies below that pricing in recent times, then that could help stabilise something like the skim milk powder market, which would have a knock-on effect to some degree into the whole milk powder market. But I think what's quite telling at the moment is that really for whole milk powder, which is 60-65% of what determines the milk price as a single product, it's really about New Zealand supply and Chinese import demand, and pretty much China's import demand looks pretty weak at the moment, and that's probably from high domestic supply, but also the retail prices not adjusting as aggressively as they should have so far.
Appreciate you joining us, speaking to Con Williams, ANZ economist, on NBR Radio.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In TPP news, a draft of part of the Trans-Pacific Partnership trade deal leaked to the Politico website suggests the US is demanding increased protections for pharmaceutical companies, restricting access to the lower-cost generic version of drugs that agencies such as New Zealand's Pharmac buy. The draft copy of the intellectual property chapter of the trade agreement as it stood on May 11 before the Guam negotiating round includes what is known as patent linkage provisions that would prevent regulators in TPP countries approving generic versions of drugs whenever there were unresolved patent issues, the Washington-based Politico website reported. It reported the draft would make linkage mandatory as it is in the US, allowing drug companies to fend off generics by claiming patent infringements. It cited Heather Bresch, chief executive of generic drug maker Mylan, as saying mandatory patent linkage would amount to a recipe for indefinite evergreening of pharmaceutical monopolies. The issue of generic drugs is sensitive in New Zealand because drug buying agency Pharmac takes advantage of the availability of generic versions of medicines to reduce the cost to Kiwis. Generics are made after a brand name drug comes off patent and typically when the developer's right to keep research secret expires. Prime Minister John Key and Trade Minister Tim Grosser have both said Pharmac's ability to access cheaper versions of drugs won't be compromised by the trade deal. Mr. Key said last month there was no chance of that and no suggestion of that, and he was quite comfortable that our capacity to have Pharmac and the benefits New Zealanders enjoy because of it will be preserved. The Politico report says the provisions in the draft TPP have implications for the next big thing for drug companies, so-called biologics, which are hugely expensive to develop and tackle conditions including rheumatoid arthritis, hepatitis B and cancer. It cited Doctors Without Borders Policy Director Rohat Malpini as saying his organisation deemed the TPP the worst ever agreement in terms of access to medicines. However, Politico also cites US trade officials saying the draft may not survive into the final form of the agreement because of the degree of compromise required to get all the signatories on board. Mr. Grosser said last week he expects that with US legislators granting President Barack Obama's administration fast-track approval powers, the 12-nation negotiators will put their real cards on the table after several years of shadowboxing. Mr. Grosser said in a speech to the US-New Zealand Partnership Forum in Auckland this week, now that Congress has spoken, it's showtime. The TPP agreement seeks a trade agreement spanning the Pacific Rim and currently involves 12 countries: New Zealand, Australia, the US, Canada, Japan, Singapore, Malaysia, Brunei, Vietnam, Chile, Peru and Mexico. Where the deal differs from other free trade agreements is that it includes alignment of regulatory settings across borders rather than simply removing quotas and tariffs. It's faced staunch opposition from those who claim it undermines national sovereignty through investor-state dispute settlement provisions and its treatment of intellectual property and medical procurement. To property values. New Zealand property values rose at the fastest pace in more than a year in June as a shortage of homes in Auckland prompted house hunters to cast their net wider to surrounding areas. According to state-owned agency Quotable Value, national property values accelerated 9.3% in the 12 months through June to $520,585. Matching the pace in February last year, values in the Auckland region surged 17% to $840,165, the fastest pace since 2004. House values in Auckland City jumped 18% in the year through June, the fastest pace in more than a decade, and pushing the average value over $1 million for the first time, as housing supply fails to keep up with demand from record migration. The agency said that's prompting house hunters to spread their net wider, pushing up values in surrounding areas. QV National spokeswoman Andrea Rush said large numbers of Aucklanders are flocking to buy property in Tauranga, Hamilton and the Western Bay of Plenty, resulting in rising values in these areas. There are reports that of those present at Hope and Homes in Tauranga, as many as 60% are regularly from Auckland, while around 15% of all buyers in the Hamilton market are now from Auckland. Values in other main centres rose at a slower, steady rate, she said. Property values in Wellington increased at an annual pace of 2% to $546,577, while Christchurch gained 3.2% to $474,269, and Dunedin advanced 2.6% to $269,048. Ms. Rush said sales volumes were ahead of the same period last year, with high migration and forecasts for lower interest rates increasing levels of activity in the housing market in many parts of the country. She said some buyers may be bringing forward purchases ahead of the stricter lending and tax changes coming into effect in October. She said values in provincial areas were mixed during the period, with some increasing, others flat, and some showing a decline. Let's compare Auckland housing to Sydney. Parallels between the Sydney and Auckland housing markets are striking, according to Shane Solly of Harbour Asset Management based in Wellington. He visited Sydney for a meeting with government agencies and residential developers who talked about the state of the market there. Harbour Asset Management has reduced exposure to listed Australian residential property developers in the face of increased volatility. Average Sydney house prices are up more than 20% over the last 2 years. New residential consents are at an all-time high of more than 200,000 a year. New state government taxes have been introduced aimed at foreign investors, and banking regulators are heavily scrutinising residential lending. The Sydney market performance is not shared by all other centres, like the Auckland versus the rest of New Zealand syndrome. Over the past 5 years, property prices have fallen in real terms in 6 out of 8 Australian capital cities. The Sydney market is driven by historical underbuilding since a tax break-driven construction boost in 2008 and 9, immigration, popularity of central areas in a 10k radius from the CBD, and low interest rates despite falling rental yields as a result of relative tax advantages. New development is picking up strongly, and government agencies and private owners are releasing land for development around transport nodes. While Sydney is hot, new supply is exceeding demand in some cases. Significant new supply in Melbourne is slowing price rises. In the resource states like Western Australia, house prices are declining as major products are completed or curtailed and interstate migration slows. The Australian Prudential Regulation Authority is due to announce stronger capital requirements for Australian banks. The Australian Reserve Bank is also considering measures targeting Sydney buyers in the same way the New Zealand Reserve Bank has done in Auckland.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio, Thursday the 2nd of July. I'm Andrew Patterson and this is Market Talk. With me I have Duncan Bridgman, and also on the line from Craig's Investment Partners, Mark Lister. Welcome to you both. Mark, let's talk firstly about the situation in Greece, of course, the dominant headline for the week. Markets seem to have taken this perhaps a lot more in their stride than one might have expected.
Yeah, that's right. We saw a little bit of a knee-jerk reaction early in the week, but things have subsided, and I guess you've got a couple of reasons for that. For a start, people are just a bit cynical about all this now. We've seen crises in Greece before, and people have got the view that ultimately we will see a deal get done at some point, and even if we don't, the risks around Greece are seen as being a little lower than they were a few years ago, with the European economy in a bit better shape, and some of those European officials having a few more tools up their sleeve to deal with any exit and so forth. Not much of an impact for New Zealand, though. No, we've been pretty insulated from it now. We're obviously on the other side of the world, so that's helpful. We don't do a lot of trade and so forth with Greece or Europe in the scheme of things. And most of our companies over here are only have very limited links into the region. So we've held up much better than some of those other markets around the world. And I think for us, what's happening in China is a lot more relevant. Yeah, well, let's talk about that, because the China stock market has been particularly volatile. In fact, in the last couple of weeks, it's wiped out all of its gains this year. In fact, it got into bear territory this week. Yeah, that's right. Sort of down 22% over the last couple of weeks if you look at the Shanghai Composite. I'm not particularly worried about this, to be honest, and the reason is it had such an outstanding run before that. I think it was up something like 150% in the 12 months leading up to that peak earlier this month. So, look, the thing just got so well and truly overheated that a bit of steam coming out of it, even a substantial fall like 22%, still puts it at pretty high levels compared to where it's been over the last few years, and I don't think that's what we've seen in the Chinese stock market is completely reflective of what's happening in the economy. So I'm much more worried and interested in what's happening sort of in terms of the Chinese economic fundamentals rather than the level of speculation from their retail investors in their own market. Duncan, what's so unique about the Chinese market? Because it's not a market that New Zealand investors can really get access to anyway.
No, that's right, Andrew. I'd sort of echo what Mark's saying. It's interesting to watch what's happening up there, but the effects on what happens here is more to do with the actual Chinese economy and obviously the demand for our goods. But what I have been interested in is just the makeup of how particularly sort of retail investors or so-called mum and dads, Chinese housewives investing, they are borrowing a huge amount of money to make their investments, and in fact, the report said about $350 billion US dollars worth of margin finance, which is what they call our sort of borrowing to invest, has gone through since the start of this year, and that's double what it was last year. So, there is a huge risk there if the market does tank. These people are quite exposed.
Yeah, absolutely. And in fact, you've heard about the Chinese farmers now that aren't ploughing the fields anymore; they're playing the stock market. So it really is looking a little bit frothy, perhaps around the top. Chorus came out today with its decision. The Commerce Commission came out with its decision on Chorus. What did you read into that, Mark? Are Chorus going to be reasonably comfortable with this price indication that it's had from the Commerce Commission?
Oh, look, there's a few positives and negatives in there. The total price they can charge for broadband services on average is broadly unchanged from the initial final pricing principle, but it's quite a bit higher than where current prices are at. So, look, the way our take on it was that there's quite a positive there in the longer term, but in the short term it's a bit of a negative. A U-turn on the backdating means that people that were expecting a dividend of around the 20 cent level for 2016 financial year, that's probably a bit too high. So long term, it's not too bad. Short term, probably not the best outcome for them.
And Duncan, did you feel the pricing was pretty well what you were expecting?
Yeah, well, it is what our technology editor Chris Keel had predicted, or there or thereabouts, and. I think short term there was a little bit of, Chorus stock is down 1% this morning, if you can read anything into that. But yeah, I think perhaps it being what it is, the earnings damage is less than initially feared. So, I think, all in all, it's probably, not too bad for Chorus.
Okay, the other big news on the M&A front this week, Briscoe's announcing its takeover for Kathmandu. Was this opportunistic, do you think, Mark?
Oh, look, I think it was. You look at the share price chart of Kathmandu, and it's really fallen off a cliff the last couple of years. Wasn't so long ago that it was close to $4 and sort of got down to 130ish. So I think there probably is a strong element of Briscoe seeing a business that's lost its way and trading at a very low share price. They obviously still see some good bones there in fundamentals. So I think there is probably a good dose of opportunism there.
And likely to get across the line, do you think?
Oh, yeah, it's a tough one to call. Kathmandu's obviously gone away and is considering it, but there are a few things that might make it difficult to get over the line. Some people will probably view it as quite opportunistic. The big scrip component could be an issue for some Kathmandu shareholders. I'm not sure if all of those, everyone on the Kathmandu register wants to end up with Briscoe shares, so that might put a few people off. Rod Duke still ends up with having a pretty serious interest in the combined business, so that also might be something that some will view as positive, some maybe not. So it'll be an interesting one to watch, but I think it might be tough for them to get over the line.
Yeah, that's what I think as well, Mark. I think while some institutions might have taken the exit route when they were offered $1.80 a share, I think some, particularly the Australian investors in Kathmandu, may struggle to get their heads around this, particularly if it's if they bought in at a higher rate. The other thing is, Rod Duke and Briscoe are going to have to convince them that they are the right sort of group to take Kathmandu forward and get it out of the slump that it's been in over the past 6 to 10 to 12 months. That said, Kathmandu's got a reasonable board, and it's just got a new chief executive. So, they'll have some numbers coming out. July for. So they've got Easter trading, they've got winter trading. They could bounce back. There's a lot of balls in the air on this one.
The other issue, of course, too, is that Briscoe's has a strong association with its current lineup, around that core retail offering. And this is getting into clothing. I mean, obviously Kathmandu does a lot, but there's a lot of clothing elements to it, which is kind of slightly outside of their expertise. Is there a risk here that the whole Briscoe's group begins to become a little bit too diversified, mate?
Oh, there's always a risk sort of when you go outside your core business and when you take on a company that's got a big exposure to a different country. Australia's been one of the big weak links for Kathmandu, so Briscoe's would inherit that market and all the stores over there and would have to sort of find a way to improve the performance over there. But, yeah, you're right. I guess the other side of it, though, is that there is a lot of commonality between retail operations and sort of inventory management and promotional activity and all those other things. And I don't think anyone will question the expertise of the Briscoe's team, because they've been outstanding compared to just about everybody else in the retail game over here. But like you say, always risks when you sort of take on a big acquisition and move into slightly new territory.
Finally, let's conclude with the global dairy trade auction price out on Thursday morning. Another nasty blow for farmers there, Duncan.
Yeah, well, it's more of the same, isn't it? And this is now starting to become quite serious, not only for farmers but for the New Zealand economy. And as we see the dollar fall again this morning on reflection of that. So, we're taking a large chunk of revenue out of the economy, and it's not just in the rural areas. There'll be other sectors that are affected, flow on from this, and it really is now sort of getting to that crunch time for some of those big dairy farmers that have got a large-scale debt, and I keep reiterating that, but they'll be really hoping for a turnaround shortly.
Is this going to create some dilemmas for the Reserve Bank, do you think, Mark?
Oh, look, my view is that we're certainly in line for another rate cut this month and probably another 2 after that. I think they'll go very close to reversing all 4 of those hikes they put through last year. So interest rates are going down. And the currency's going down as well. It's pretty clear how things are going to pan out from here in my mind.
Thank you both for joining us. Mark Lister from Craig's Investment Partners and Duncan Bridgman on NBR Radio.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In business news, retail magnate Rod Duke knows he's probably going to have to win the hearts and minds of retail investors if Briscoe Group's bid for Kathmandu is to succeed. And he's not going to let his 2-year personal involvement with a flailing children's clothing chain Pumpkin Patch give opponents ammunition to attack him over. Not that that concerns him greatly, because Briscoe's and Rebel Sports provides more than enough evidence he and his team are capable of taking Kathmandu and lifting it out of the blind spot it's currently in. He says, to be fair, nobody knows what my real involvement at the coalface of Pumpkin Patch has in fact been. Mr. Duke says when asked about his shareholding and directorship for the past 2 years at the struggling company. He says, all I can point to is our experience at Briscoe's and Rebel Sport, and I don't think anybody is going to be punching any holes in that one. Briscoe's takeover of Kathmandu, tabled yesterday, is likely to attract some opposition, however, with some already labelling it hostile and opportunistic. But the ease in which Briscoe built its current 19.9% stake, with as yet unidentified institutions taking up Briscoe's off-market $180 a share pre-bid deal, suggests investors are not happy at Kathmandu's future under its current setup. Shares in the outdoor equipment and clothing chain have hit all-time lows after its half-year loss, and after it lost its previous chief executive, Peter Helkett. Briscoe's bid arrived the day after new chief executive Xavier Simonet started his job. Kathmandu has engaged investment bank Goldman Sachs as its defence advisor. Goldman Sachs Asset Management is the retailer's largest shareholder with a 12.3% stake. Briscoe's mainly scrip offer amounts to $180 per Kathmandu share, based on $288 per Briscoe share, and gives an enterprise value of $418.2 million. Mr. Duke's holding of the enlarged group would shrink to 55.1% from about 80% of Briscoe Group, ensuring the retail executive retains control. To banking and farming. Post-global financial crash bank reforms are significant in the context of farmers weathering high debt and commodity price downturn. This is the view of Hayden Dillon, Head of Corporate Agribusiness and Capital Advisory for Crowe Horwath. He says the person making the ultimate decisions about farm support is unlikely to be the bank manager a farmer has a relationship with. The ultimate decision maker is likely to be someone higher up the hierarchy. Mr. Dillon's own business pitch in this discussion is the importance of an independent advisor providing the farm business with a set of normalised accounts. He says during the GFC there were consequences of farmers relying on their banker to do their budget. Although banks would draw comfort from being shown that historical expenditure during good periods had led to productivity increases, they also wanted to see expenditures could be reduced without materially affecting production in the event of low payouts. The objective is to provide a set of normalised accounts to allow a sustainable year evaluation to be done. It needs to be completed by an independent advisor so the farmer has credibility with the ultimate decision maker at the bank, according to Mr. Dillon. The good news is that banks are now well positioned in terms of capital. Mr. Dillon says, but it's not good enough to just say you'll cut costs when talking to your bank. They require information about what normalised costs are and being able to justify them, and accurate information on hand and a process to make decisions quickly when faced with drought, flood, change in milk price or costs. Farmers need to understand the ramifications of their banker making assumptions on their behalf, as opposed to providing assistance and advice.
NBR Radio, Thursday, the 2nd of July. I'm Andrew Patterson. With me, Chris Keel. Chris, the Commerce Commission announcing its final pricing for Chorus. What was the final decision?
The final decision was that it stuck with its December pricing. So Chorus is going to have to reduce its copper pricing, but it's only about half the original amount that it thought it would have to reduce it by back when it went into panic mode over the $1 billion hit to its earnings up to 2019. So relatively speaking, it's a win for the company. They did take a couple of minor hits. The regulator decided not to backdate the decision, and since its earlier decision was $34, today's $38, that would have been a bit of a win for Chorus. And we've had Call Plus as boss, so he's pretty dark on the thing overall, says our broadband is still more expensive than overseas, but he has noted that the Commerce Commission's also thrown in some good one-offs, such as much cheaper connection charges.
Any reaction from the two major players, Spark and Vodafone?
Yeah, we've heard from Spark so far, and it's reiterated its independent study it did, which found that New Zealanders, our wholesale broadband is about 70% more expensive than comparable countries. But this morning we had Stephen Gale, who's the telecommunications regulator, rebutting that point. And essentially he picked up Chorus's point, which is the familiar argument from that side of the fence that New Zealand is a small, narrow country with a sparse population, so we've got bigger engineering challenges than some of the more densely packed European countries that were named in that report.
Did the Commerce Commission elaborate much on how they actually arrived at the decision? What was taken into account in this next move on the pricing?
Yeah, they were looking at two things. One was the international benchmarking, where they've obviously fallen on Chorus's side of the fence, and the other point of contention was what it would cost to build the copper network or an equivalent modern network if you started again today, which is sort of a very hypothetical, how long is a piece of string exercise, and Chorus's opponents said, well, today you'd use mobile and wireless technology, and Chorus was saying, no, cost a whole lot more, so with its centre of gravity leaned a bit more towards Chorus with the Comcom's final decision there.
And this isn't actually final. They can all parties can still engage in response to this announcement today.
Yeah, there's going to be submissions, cross submissions, and consultation. But I think all of the parties, there's a general feeling that this is probably where it's going to land now.
and the fact that it's come around at a pricing that seems to be somewhere midpoint amongst where everybody is, it's probably going to be pretty close to that in the end.
Yeah, I think so. And it's got to be satisfying for Chorus's CEO, Mark Ratcliffe, because, I mean, this time last year I really thought he was probably gone for all money. They'd convinced John Key and Amy Adams that there should be a law change so the government, which now is a 25% shareholding in Chorus, could directly set the price, but opponents said, that would be like the bad old days when the government set the price of butter, and they couldn't get ACT and United Future on board, so then that fell over. And then Chorus went to the High Court, lost, went to the Court of Appeal, lost. So this, what was called the final pricing principles review, is really the last best hope for Chorus, and it's come through reasonably well for them.
Okay, so he might be sleeping a bit better at night these days.
I think he will be, yeah. And analysts at NBR was speaking to yesterday, they think that Chorus is probably going to kick in again with dividends over the next year, so they should be happier shareholders as well.
All right, thanks for joining us, Chris Keel, with us on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
In People News, a Wellington accountant has been suspended as a chartered accountant after going bankrupt, but continues to work in the industry despite an inability to manage his own finances. Brian John Hutton of Upper Hutt was last month suspended as a chartered accountant by the New Zealand Institute of Chartered Accountants Disciplinary Tribunal. In February, Mr Hutton was adjudicated bankrupt for reasons unrelated to the accounting profession, and while he was not engaged in accounting work. He self-reported the issue to the Institute, seeking to be convicted and discharged, while the Institute's conduct committee sought suspension. In a judgment today, the tribunal says Mr Hutton is now working for a chartered accountancy firm, meaning the suspension of his membership for the duration of his bankruptcy was an appropriate penalty. He said in the tribunal's view, a member's bankruptcy indicates their inability to manage their own finances and affairs and reflects on the profession. Mr Hutton sought name suppression, but the tribunal found the public interest outweighed his own. It said although at the time of the bankruptcy the member was not engaged in accounting work and the bankruptcy was unrelated to his profession, the member is currently working for an accounting firm. Mr Hutton was ordered to pay costs of $1,000, less than half of what the Institute's conduct committee sought. To commodity prices. New Zealand commodity prices fell for the third consecutive month in June to a 3-year low on weakness in aluminium, dairy and meat. The ANZ Commodity Price Index for June declined 3.1%, following a 4.7% fall in May and a 7.4% drop in April. The index is now about 20% lower than June last year. Weaker commodity prices are weighing on New Zealand economic growth, which grew at the slowest quarterly pace in 2 years in the first 3 months of the year. Prices in the benchmark GDT auction overnight dropped 5.9% to their lowest level in 6 years, stoking speculation the Reserve Bank could reduce interest rates 3 more times this year. In the ANZ series, aluminium prices led declines, down 6.4% amid higher Chinese production. Dairy prices dropped 4.4%, led by a 7.8% fall in butter, a 5.2% drop in skim milk powder, a 4.7% drop in whole milk powder, and a 1.8% fall in cheese prices. ANZ agri-economist Con Williams said international dairy prices continue to languish given high global production, lacklustre demand from China, and the continued ban on dairy imports into Russia. Meat prices slipped 3.4%, beef dropped 2.8% as US beef prices pulled back in recent months from record levels. Lamb prices also fell, down 3.5% on oversupply in New Zealand's main export markets of the UK and China. Forestry prices were the only commodity group to increase in June, edging up 0.1% during the month. Horticulture prices were little changed as a lift in early season apple prices was offset by lower kiwi fruit prices. The NZD index advanced 2.9% as a lower New Zealand dollar buffered the impact of weaker world prices. The TWI declined 4.6% over the month. Mr Williams said the decline will be a welcome relief for many commodity exporters who are facing challenging international market conditions. To the wine industry, Marlborough Lines has bought an 80% stake for $89 million in Yealands Wine Group, New Zealand's sixth largest wine exporter. The companies say the South Island Electricity Lines Company took control from founder Peter Yealands, who wanted to keep the winery fully New Zealand-owned. Marlborough Lines is debt-free and had realised $100 million in cash from investments which it wanted to reinvest locally. Marlborough Lines Managing Director Ken Forrest says opportunities to invest in the electricity industry are limited, and this led to us looking to other options. We're satisfied this will be a successful investment which will broaden our asset base for the benefit of Marlborough people. Last December, Yealands Wine Group hired investment bank UBS to advise on capital raising options, including a possible IPO to expand its vineyard assets and grape supply. The company didn't give a capital raising target at the time. Yealands Wine was created in 2011 through the merger of Yealands Estate Wines and Ager Sectus Wine Estates. It has 1,200 hectares of vines and exports more than 1 million cases a year to more than 80 countries. The company is primarily looking to expand Sauvignon Blanc in Marlborough, although the strategic review will be wide-ranging, it said at the time.
NBR Radio. Free to air online with business news you can use.
To Christchurch is Prime Minister John Key sending in Mr Fix-It Stephen Joyce to hurry Canterbury earthquake recovery Jerry Brownlee along. This is the view of Labour's Canterbury earthquake recovery spokeswoman Ruth Dyson. She says the new transitional agency announced by Mr Key appears to be just Sarah with a new name. Ms Dyson says, but the community is crying out for a new approach to get things moving. She said one of the slowest and most frustrating parts of the recovery has been the lack of progress under Sarah on the central city rebuild. Instead, Mr Brownlee has announced a new agency with much the same functions and approach. The announcement that MBIE will be picking up many of the functions of the residential rebuild is also an admission that progress has been too slow. Ms Dyson says chucking a new coat of paint on the same old way of doing things is no way to regenerate Christchurch. To the dairy industry, Fonterra has begun talks with finance, legal and information services staff as it looks to cut hundreds of jobs and cut costs. The company says consultation over job cuts globally had started within the procurement, finance, information services, human resources, strategy and legal teams. Other parts of the business will follow in the coming months. Voluntary redundancies are in the mix, and some teams have reportedly been told they could lose half their number, according to the Waikato Times. After the dairy group met with more than 150 of its Hamilton staff, staff have been warned against talking to the media. Business management consultancy McKinsey & Co. has been hired to help the review of Fonterra's global operations, part of a strategy Chief Executive Teo Spearing says is needed to ensure the cooperative is best placed to respond to a rapidly changing global environment. Mr Spearing says the review has identified potential areas where the company could unlock increased value for its owners, including significant initiatives in procurement, business operations and working capital. He says we have the right strategy and the long-term future of dairy is sound. However, the world is changing and global dairy markets are increasingly volatile. To keep ahead of the game, we need to be more agile, reduce costs and generate value. Fonterra has faced criticism from shareholders over its underlying management performance, particularly as a falling farm gate price since the middle of last year put farmers under pressure. Dairy prices sank to a new 6-year low overnight, led by whole milk powder, the biggest product by volume Fonterra sells at auction. Whole milk powder sank 10.8% to US $2.05 for a tonne, reaching the lowest level since demand was sapped by the global financial crisis. Fonterra shareholders' fund units, which are entitled to dividends from the company's ordinary shares, were last at $4.84 and have dropped 19% this year. In TPP news, a draft of part of the Trans-Pacific Partnership trade deal leaked to the Politico website suggests the US is demanding increased protections for pharmaceutical companies, restricting access to the lower-cost generic version of drugs that agencies such as New Zealand's Pharmac buy. The draft copy of the intellectual property chapter of the trade agreement, as it stood on May 11, before the Guam negotiating round, includes what is known as patent linkage provisions that would prevent regulators in TPP countries approving generic versions of drugs whenever there were unresolved patent issues, the Washington-based Politico website reported. It reported the draft would make linkage mandatory, as it is in the US, allowing drug companies to fend off generics by claiming patent infringements. It cited Heather Bresch, chief executive of generic drug maker Mylan, as saying mandatory patent linkage would amount to a recipe for indefinite evergreening of pharmaceutical monopolies. The issue of generic drugs is sensitive in New Zealand because drug buying agency Pharmac takes advantage of the availability of generic versions of medicines to reduce the cost to Kiwis. Generics are made after a brand name drug comes off patent and typically when the developer's right to keep research secret expires. Prime Minister John Key and Trade Minister Tim Grosser have both said Pharmac's ability to access cheaper versions of drugs won't be compromised by the trade deal. Mr. Key said last month there was no chance of that and no suggestion of that, and he was quite comfortable that our capacity to have Pharmac and the benefits New Zealanders enjoy because of it will be preserved. The Politico report says the provisions in the draft TPP have implications for the next big thing for drug companies, so-called biologics, which are hugely expensive to develop and tackle conditions including rheumatoid arthritis, hepatitis B and cancer. It cited Doctors Without Borders Policy Director Rohat Malpini as saying his organisation deemed the TPP the worst ever agreement in terms of access to medicines. However, Politico also cites US trade officials saying the draft may not survive into the final form of the agreement because of the degree of compromise required to get all the signatories on board. Mr. Grosser said last week he expects that with US legislators granting President Barack Obama's administration fast-track approval powers, the 12-nation negotiators will put their real cards on the table after several years of shadowboxing. Mr. Grosser said in a speech to the US-New Zealand Partnership Forum in Auckland this week, now that Congress has spoken, it's showtime. The TPP agreement seeks a trade agreement spanning the Pacific Rim and currently involves 12 countries: New Zealand, Australia, the US, Canada, Japan, Singapore, Malaysia, Brunei, Vietnam, Chile, Peru and Mexico. Where the deal differs from other free trade agreements is that it includes alignment of regulatory settings across borders rather than simply removing quotas and tariffs. It's faced staunch opposition from those who claim it undermines national sovereignty through investor-state dispute settlement provisions and its treatment of intellectual property and medical procurement.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
Back to the copper lines decision today. The Commerce Commission's latest decision not to backdate changes to its rulings on copper telephone and broadband line prices will mean telco retailers get to keep about $57 million, but will have to pay lines company Chorus something less than $864,000 a year more than the regulator's last draft ruling. That's because the corporate regulator has raised its regulated price for copper wire services to $38.43 a month, 4 cents more than its last ruling in December. But overall, the tiny change in pricing is a win for Chorus because it's $3.99 more than the Commission's original benchmarking decision in November 2013. That original decision, or $34.44, is what the retailers have actually been paying since December last year. However, this still isn't the final decision. That's not due until December. The largest telco, Spark, estimates that if today's decision stands, that it will cost it about $42 million a year more than it's currently paying. Naturally, Spark Managing Director Simon Muta says he's disappointed with the decision and continues to argue wholesale line charges in New Zealand are about 70% higher than in comparable countries. Spark had been running an email lobbying campaign called Be Counted to try to persuade the regulator to lower the price of copper services. Telecommunications Commissioner Stephen Gale says his organisation welcomed Spark's campaign and says it looked very carefully at international comparisons but concluded it costs more to install telephone lines in New Zealand. That's largely because New Zealanders are far more dispersed than people in European countries. Trenching costs 63% more in New Zealand than in Sweden, and it takes 26% more cable to connect the average New Zealander than it takes to connect the average Swede, according to Mr Gale. Mr Muta welcomed the decision not to backdate, something the Commission previously foreshadowed. That caused Spark to raise prices of most of its broadband and landline charges in February. Mr Muta says if the Commission confirms the decision not to backdate in its final ruling, Spark will honour its commitment to return that windfall to customers. But he's warning that if the Commission reverses that backdating decision, that will put more upward pressure on retail prices because Spark has only partly recovered the increased charges so far. To the Christchurch recovery, although not anymore. Christchurch's recovery has now become regeneration, according to the government's spin masters. A new Greater Christchurch Regeneration Bill will replace the Canterbury Earthquake Recovery Act 2011, which expires next April. Prime Minister John Key outlined the changes in a State of the Nation speech at a crowded Canterbury Employers Chamber of Commerce lunch attended by hundreds of business people. A new bureaucracy called Regenerate Christchurch will be set up. The new organisation will have primary responsibility for the development within Christchurch's 4 avenues and delivery of the Crown's major projects and precincts in the central city. Some functions carried out by SERA will be passed to other government agencies, and others will be transferred into a business unit within the Department of Prime Minister and Cabinet. The proposed changes are explained in detail in the draft Transition Recovery Plan, which will be released today for public submission by SERA Acting Chief Executive John Ombler. Mr Key reiterated the government's commitment to anchor projects such as a convention centre and metro sports facility, but says announcements will be made in coming months about them. However, he did unveil plans for new central city housing. Fletcher Residential has won a tender to become the preferred developer to work with the government on the $800 million east and north frame of the Central Business District residential precinct, providing around 940 new townhouses and apartments, accommodating up to 2,200 residents. Fletcher Residential has provided the government with concept images for the proposed developments across the east and north frames, broken down into 3 areas of housing and supported by small-scale commercial development and community facilities. According to an official statement, if the development agreement is confirmed later this year, Fletcher Residential will progressively buy 7 hectares of land in the east and north frames between Manchester and Madras Streets, from just north of the Avon River to Litchfield Street, to develop the housing. Construction will be spread over 8 or 9 years, with the first homes expected to be complete within 18 months of a development agreement being signed. That final agreement is likely to be signed by the end of November this year. Fletcher Residential will set the prices when the homes go onto market, but most are likely to be within 400 and 900,000, providing opportunity for a range of living situations. The first thing people will see will be the development of the public spaces in the east and north frame by the government from later this year. Let's talk honey. Following an in-depth review by the Ministry for Primary Industries, the interim guidelines for the labelling and classification of Manuka honey has left the $130 million industry in a worse state than before. That's according to 2 honey industry leaders who say MPI has helped legitimise the wholesale counterfeiting of Manuka honey through its new guidelines, which permit a blending of industrial quantities of New Zealand field clover honeys with minuscule quantities of Manuka honey to be legally sold overseas as New Zealand Manuka honey. The managing director of Canterbury-based Airborne Honey, Peter Bray, says the guidelines are so wide you could drive a truck through them. The fact is, he says, that MPI stepped into the breach because it believed there was a problem and tried to develop the guidelines. What I believe that it's done is put an aura of authenticity over the problems that were already occurring. In a February 5th, 2014 letter, MPI's Deputy Director General Scott Gallagher and the Ministry's Science Advisor Ian Ferguson informed the country's foremost honey producers, "From our work to date, it's clear there is general agreement the way some Manuka honey is currently labelled and marketed is potentially confusing for customers and may be creating the potential for fraud or misleading practices. In international markets, these factors could translate into damage both to the Manuka honey brand and to New Zealand's wider trading reputation." In a Manuka honey presentation to the industry 5 days later, Mr Gallagher told producers that success depends on confidence of consumers, markets and regulators that the product consumers are buying is authentic, statements made on labels are true and accurate, New Zealand's reputation for integrity and credibility is paramount, doing nothing is not an option. However, Airborne Honey's Peter Bray says he believes the guidelines have been worse than doing nothing, as they legitimise the practices in play. Bees produced 187 million of exported honey in the June 24 year, up 8% by volume and almost 30% by value on the previous year. According to industry interpretations of the new guidelines, an overseas importer could import 99 44-gallon drums of clover honey from this country and mix it with a single 44-gallon drum of New Zealand Manuka honey and label it as New Zealand Manuka honey. Mr Bray says that's what you can physically do with the existing guidelines. New Zealand, he says, is selling these blended honeys into the international market far in excess of our production. Our trading partners in the UK and China in particular are getting anxious about it. For more on this, go to nbr.co.nz.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.